Good afternoon and welcome to Deutsche Telekom's webinar. Please note that this call will be recorded and uploaded to the internet. May I now hand you over to Mr. Andreas Puy.
Yeah, good afternoon and a warm welcome to all of you to our third webinar. This time it is on the pension schemes used at Deutsche Telekom. We have invited today two experts in this field. Carsten Velten from the HR department of Deutsche Telekom, the expert within the group about all the different pension plans we have, and Guillaume Maisondieu, head of accounting at DT, who is the expert on the treatment of the pension obligations within P&L, balance sheet, and cash flow statement. As always, the disclaimer is part of the slide deck today, and hopefully with that I can now hand over to Carsten for his part of the presentation.
So thanks, Andreas, and good afternoon to all of you. It's my pleasure to be here and share with you some insights into the different pension schemes of Deutsche Telekom Group. As a brief introduction to myself, my name is Carsten Velten and I'm responsible for global pensions in the group, and I'd like to start with some short general remarks on pensions. The reasons for pension schemes at Deutsche Telekom, as well as at other companies, are manifold. First, we have legacy reasons. The pension schemes at Deutsche Telekom in Germany have a history that started long before privatization, when Deutsche Telekom was still a public service company. The reasoning behind the introduction was to bridge the gap in pensions between civil servants and other employees. Second, it is part of the standard compensation package for almost all bigger corporations in Germany, and an important element to increase attractiveness as an employer, attract talents from the labor market, and increase employee loyalty and satisfaction. Third, mergers and acquisitions like Debis in Germany or international acquisitions like OT just mentioned, to mention two of the biggest ones, added new pension schemes into the group. And fourth, there might also be requirements stemming from union agreements or legal requirements. The specific legal requirements vary from country to country, and different fields of law like labor law or tax law need to be taken into consideration. Whereas in Germany, as a general rule, the pensions are of voluntary nature, they are mandatory or partly mandatory in some other countries in Eastern Europe, Scandinavia or Switzerland. And since very recently, you might know, even the UK has introduced mandatory plans. Execution, funding and arrangement of plans differ significantly from each other in the different geographies, whereas the Anglo-Saxon world has seen a material shift from defined benefit to defined contribution. I will dive deeper into the details a bit later. Pure defined contribution plans are still not allowed in Germany. So having said that, let's go on the next slide into some fundamental difference between defined benefit and defined contribution. In defined contribution plans, the obligation of the employer is limited to the amount of fixed contributions paid to the fund. That means that there is no legal obligation to pay further contributions if the fund does not hold sufficient assets to cover the benefits. Therefore, risks like actuarial or investment risks fall only to the employee. Consequently, these plans are also not considered as a liability and no provision is recorded. Cash payments for these plans equal the expenses recorded in the profit and loss statement and are included in the EBITDA as personal expenses. Famous examples are 401k plans in the US. A lot of Eastern European countries have DC, and also the German civil servant pension plan is DC. In a defined benefit world, the risk mainly falls to the employer. He promises to pay a certain amount of cash or a lifelong annuity to the pensioner, and this pension promise can even be subject to future salary increases or increase of the statutory pension scheme. That means that the future payment obligation, as well as the total net present value of the liability of such a pension promise, is not that easy to measure, as it is very much depending on parameters like interest or discount rates, life expectancy, and other calculation parameters. In the context of the International Financial Reporting Standard, the net present value of this payment promise is called the defined benefit obligation, which after deduction of existing plan assets results then in the provision shown on the balance sheet. Staff costs are then included as service costs within the net periodic pension costs. They are calculated according to special IFRS rules, and they usually have nothing to do with the actual cash contributions, which I told before are, especially in Germany, voluntary, and therefore they can vary from 0 to 100% funding and above. DBO plans expose the employer to a financial risk, which we have, and that is the reason why we have introduced a group-wide risk management and a global pension policy that defines minimum standards for the management of pension schemes within the Deutsche Telekom group. So turning the page over, let us now briefly talk about the subject of civil servants, which are around 42,000 people as an example for a DC model. The obligation to actually pay for the pensions of the civil servants employed at Deutsche Telekom is within government entity, the so-called Postbeamtenkasse, and Deutsche Telekom now has to pay 1/3 of the salaries of the civil servants in Deutsche Telekom to this entity. On the first side, that may sound expensive. However, let me assure that this, in fact, was a rather good deal for Deutsche Telekom, as the payment is only defined by the number of civil servants and their salary, of course, being currently employed at Deutsche Telekom. However, the actual obligation of already existing pensioners has no impact. If this amount we pay is then sufficient to cover the actual pension obligation or not, is no longer Deutsche Telekom's business. As there is no further payment obligation, it is not accounted for as a balance sheet item, and this is the reason then why it's defined contribution and not defined benefit. Actual payments made in 2013 were close to 600 million euro and will shrink within the next 15 years down to around 100 million euro. The reason for the decrease is that the number of civil servants employed at Deutsche Telekom will decrease strongly over the next years. So let us now, on the next page, turn to the specific situation of defined benefit plans accounted for on the balance sheet. Out of 180 billion euro total balance sheet, the pension provision accounts for approximately 7 billion euro, which is about 6%, and in comparison to other DAX companies, a rather small amount. The plan assets, with about 2 billion euro, cover approximately 20% of the total benefit obligation of approximately 9 billion euro. The provision on the balance sheet reflects the net present value of the future pension payments, the so-called defined benefit obligation. This present value is based on an actuarial calculation of the pension obligation. Plan assets are then deducted from the defined benefit obligation, and the result is the provision or the so-called defined benefit liability shown in the balance sheet. The majority of 92% of the defined benefit obligation is coming from the German plans. With around 260 million DBO following with a huge gap plans in Greece, obviously as a consequence of the full consolidation of OT following the acquisition. Then Switzerland with around 190 million DBO. If we then had a look at UK and Netherlands as well, we would cover around 99% of all pension obligations of the group. So, and as Germany is forming then the bulk of the obligations, let me on the next line explain a little bit more detail how the German plans work and how the amount a pensioner receives is being calculated. So next slide. The overwhelming part of our German employees today are salaried employees, and different to civil servants. All of them receive a company pension. Currently, we have approximately 95,000 active employees, 65,000 vested obligation from former employees, and 40,000 retirees. Historically, the employees in Germany received a company pension that helped to bridge the gap between the higher civil servant pension scheme and the regular payment by the statutory pension insurance. Following the privatization, this scheme was replaced by a modern defined benefit plan. The employee receives an annual credit, which is salary linked and includes a guaranteed interest rate, which is currently 3.75%. And that might be more easy to understand by just looking at the example at the right side of the slide. So let's assume there is an employee with an annual salary of 50,000 euro, age of 50. Then the calculation that mainly consists of the two components, a contribution component and an interest component called H factor, which in total then is salary 50,000 multiplied by 2.5% equals 1,250 multiplied by H factor, resulting then in a guaranteed cash amount or credit accrued for this year of 1,975 euro. These credits are then accumulated year by year in a so-called Kapitalkontenplan or capital accounting plan, and are being paid out in case of being retired, death, or disability, either as a lump sum, an annual installment, or a lifelong annuity. And the two important points now are, first, although contribution rates and interest rates are important components of the plan design, at the very end, it is the annual credit which is granted by the company, and therefore it is still a defined benefit and not a defined contribution system. And second, however, the liability now, or if you like, the defined benefit obligation according to IFRS, is only depending on the present value of this credit or cash amount. Future salary increases or changes in life expectancy do not or almost not influence the credits accrued so far. And they do not influence the so-called past service, and they do not influence the defined benefit obligation. So coming to an end, within the restriction of the German legislation, we think that the plan design of this pension plan, of the capital accounting plan, limits risk significantly. Yeah, with that, I'd like to hand over to Guillaume. Thank you.
Thank you very much, Carsten. So let me introduce myself briefly. As Andreas said before, I'm an accountant at Deutsche Telekom. Very happy to lead you few topics. First part of the presentation is on the management of the plan assets, the impact of the defined benefit schemes, and of course, the implications for our P&L balance sheet and cash flow. We'll also talk about the most important parameters influencing our pension liability and its volatility. And I will give at the end, of course, an outlook of the expected future cash payments for pensions. So you remember Carsten spoke about our funding. And what is important here, it's we have absolutely no obligation to fund. So it's really on a voluntary basis. And I think what needs to be stressed here is that the key investment objective is very much to control and to protect the funding ratio. So what does this mean? It means we always take both sides of the balance, assets and liabilities, into consideration. The main principle of our asset management is to improve the ratio of assets and liabilities. It's not our first priority to achieve the highest absolute return of asset performance, but to achieve the funding ratio as planned. It means we committed ourselves to achieve at least a specific return on our planned assets that end in combination with further funding at our target funding ratio, and we'll be talking afterwards about this funding ratio. To reach our objectives, we are working closely together with our fiduciary manager, who advises us in investment and risk management decisions, is responsible for the creation of a so-called ILM study. It's an annual asset liability management study. He advises us in the selection of the appropriate fund managers and is doing the administrative implementation of the investment strategy, as well as reporting, of course, and monitoring of the assets and liabilities. So the basic idea of this cooperation is to use a broad expertise in a holistic management of the related tasks. And due to the cooperation with the fiduciary manager, we are able to keep relatively lean internal structures in the area of asset management. Within the framework of this so-called LM study, and according to our risk preference, we determine our strategic asset allocation. Now here, a few major items related to this one. So this so-called SAA, strategic asset allocation, is global, of course, and diversifies. And we have here, of course, a variety, as you see here on the chart, of asset classes. Time being 75% bonds, 20% equities, 5% alternative investments. SAA is a mix of a liability-driven and return-seeking portfolio. To control the funding ratio in different market environments, we established a risk overlay management That means that we have an overlay that will protect our asset portfolio if we're exposed to lose a significant part of the funding level. And all our investment decisions, of course, consider specific ESG criteria, for instance, no investments in controversial weapons and related industries. Should the future performance of our planned assets indicate disbelief to reach our target funding ratio, we may reconsider, of course, the strategy and switch to a more risky one. The decision about the strategic asset allocation is taken at highest management level. We have here a so-called pension asset committee, and we have, of course, a number of experts in there and 3 board members of DT Group. Now, let's jump to the next slide, and there you see our funding ratio targets. It's 50% end of 2020. So what does it mean concretely? I mean, we started with below 10% in 2010, and end of 2013, we had reached a ratio of 22%. So you see some good progress there. We have, of course, two main options, and we're working on both of them to reach the 50%. The one is via the return on the plan assets, as described before, and the other one is via the annual funding. Talking about the annual funding, we have defined a minimum contribution on an annual basis of 250 million euros. So this is what we do at the time being, sometimes more. I mean, 2 years ago, we did far more than that. So here we have some kind of a flexibility, but once again, 250 as a minimum amount year for year. What concerns the return on plan assets, I think we have quite an impressive track record to share with you, as the return of the plan assets between 2011 and today was over 20%. You have heard before that the funding is done on a voluntary basis. So once again, absolutely no obligation. So you could ask yourself, why are we doing this? I mean, first, as a matter of fact, we want to reduce our future risk. We want to have some flexibility and the option to make future pension payments either directly from the cash flow or from the CTA. So once again, higher flexibility in cash flow steering. And of course, we want also to move with our funding ratio towards the average of our DAX here, so the main 30 groups in Germany. Now, if we move over to the next slides, now we have, of course, the crucial part, I would say, because we're talking about the accounting part and the implications for our balance sheet and P&L. So here you have quite, I would say, a comprehensive view of major impacts and the development of our DBO in 2013. And if we focus there on the subject of how the pension obligation developed, you see here the major impacts. So once again, and Carsten mentioned it before, the DBO is a net present value of our future payment obligations. Yeah. So this is a provision we have fundamentally on our balance sheet. What happened in 2013? You see that the DBO is nearly unchanged, but we have very many different effects. So the pension costs accrued for the future and the actual cash payments almost offset each other. I think this is one of the major items that you can take as a summary. Still, if we go for kind of a deep dive here, you see pension costs in the amount of 388 million. From net service costs recognized in EBITDA and from interest costs. So you have the EBITDA part with 160 service costs net, and you have the financial reserve part with 282 here. What is important to be noticed is, but of course you don't have it here because you were talking about the liability side, but you have also in the financial result the expected return on plan assets. And for this we had in year 13, 4 million euros. Yeah. So this is not reflected, of course, on the liability side, but of course, this is part of the asset side. Right. Now, if we look at the total payment to pensioners in 408, you see that the major part was directly paid against provisions, 366, and part of it from plan assets, 42. 366 are part of our free cash flow, whereas the 42 are only that are indirectly financed by us through the plan assets and are not directly part of our DT's cash flow. Remember that Carsten mentioned that there are several parameters which are determining the calculation of the net present value. These parameters include discount rate, life expectancy, salary trends, etc. We'll talk about the sensitivities later on. But I think what is important to be seen here, you have this OCI part with the remeasurement effects. This was a very, very little part in year 13. You see the impact of 33, and on the FX part, only 6. What is important to be seen here is this was kind of a very flattish year, but in 2012, perhaps some of you remember, we had here a negative impact because the interest rates went so much down. We had an impact negative on our equity of 1.8 billion euros. And if we consider current year, you could have read in our half-year report that we already have also, because of the interest rates reduction and with a direct impact on our pension interest rate, we already have a negative impact here in our OCI of 600 million euros. So, I mean, the flattish 33 is really something that is very, very special, a certain perspective, because the year before and in the first months of this year, we have very strong impacts related to the reduction of interest rates. All right, and others are very little figures related here to contributions made by plan participants and changes attributable to M&A activities. If we now move over to the asset side and to the funding. So once again, you remember it's a major offsetting factor against the DBO, and you see it here, on the right-hand side. If you look now at this evolution, on the one hand, you see the funding. So we had last year's 250 as a minimum, plus 19 related to schemes we have in the UK, in Switzerland, and the Netherlands. If we now look at the 67, you remember I just talked about 54. 54 is what was expected. Finally, the return was better by 13, and this is the difference. So the return as such was 67. And we had payments, as already said before, 42. So this is really the bridge from plan assets at the end of 2012 and plan assets at the 2013, end of 2013. These are the main impacts we had here. If we now move over to the sensitivities, and I think it's already a little bit what I raised now, as a matter of fact, with our discount rate, and once again very much related to the evolution of interest rates. So the upper diagram shows you the historic development for some of these parameters. We notice that, as a matter of fact, the discount rate has come down significantly over the last 2 years, and we still have this trend now this year, in the first half of the year at least, reflecting basically today's very low interest rate environment. So we could also say at the same time that with what we have in the balance sheet, we feel pretty comfortable, because the other way around, of course, the day interest rates raise, we have here a positive impact because a reduction of our provision and positive impact OCI and in equity. So, I mean, if we believe, and nobody really knows, but that we have reached kind of the bottom of the development of the interest rates, I would say we have a very good position for some upsides here in the balance sheet. So when we look here at the sensitivities as such, once again, talking about 100 basis points here of our discount rate, it's roughly 1 billion we're in change in liability. Yeah, so these are the impacts we're talking about. And so if we look at the change between 2011 and 2012 of the discount rate from 5.31 to 3.26, this was 1.8 billion in the OCI, 1.8 billion on our equity. Right. Salaries or pension increase rate, how you can see it here, just have a marginal impact, and this is very much related to what Carsten said before, because I mean these topics are very much fixed and therefore no real impact, you could say, on the DBO, whereas the life expectancy has an impact and therefore is very much under observation, but I would say we don't have a huge volatility there. Right, if we now move to the outlook, we expect the payments to decrease by a CAGR of nearly 2% over the next year. I mean, next year. This is very much related to the payments for the civil servants, which will be decreasing until 2018 and beyond, very much related to the current age structure of our civil servants, and as a matter of fact, also to the fact that there's a decrease, over time. In 17 and 18, we expect a temporary slowing down of this effect as early retirement opportunities will be significantly used until 2016. As a result of the early retirement, the natural fluctuation thereafter is limited, and in combination with an expected increase in salaries, the payments will slightly increase. Nevertheless, in 15 years from now, we expect that the level of payments for this purpose will be on a level of approximately 100 million only. The age structure of our current employees is also the predominant factor for the increase of benefit payments. A growing number of retirees will increase the payments we expect until 2017. The slight decrease in 2018 is due to the fact that we, again, temporarily expect less retirees to leave the company in 2017. So now let me wrap up with major topics we just presented. First, I think it's important is we have defined contribution plan schemes, but they do not constitute a liability. It's very particular, it's very much related to the civil servants as Carsten presented it. We have defined benefit plans, and once again, I mean, 90% of the liability is related to Germany, so very much focused on Germany. No funding required by law, unlike BT, for instance. But we believe it makes sense to go for funding. Foremost, we introduced here a fixed contribution model that very much limits volatility of our obligation. And finally, with the funding, we believe we further de-risk this liability. So we have this goal of a 50% funding until 2020. I would say we're very well on track to achieve this, and so to de-risk and to have this topic very much under control. You saw the CAGR, you saw the cash outflows being reduced year by year. So in a nutshell, the topic is very robust here at Deutsche Telekom, very much under control, and we're doing everything we can on top to further de-risk and to further have it under control. These would be the main items here. Of course, we have a lot of details for you if you wish. So thank you for listening, and now we're open for your questions or comments. Thank you.
Thank you very much, Guillaume and Carsten. And now it's time for the Q&A part. If you would like to ask a question, please press *1 on your touch-tone telephone. The operator will announce your name when it's your turn to ask a question. Should you require to cancel your question, please press the #. In addition, you can also send your questions via email to investor.relations@telekom.de or via Twitter if you account the @DT_IR tag in your tweet. The first question for today comes from the internet. It was being sent by Fred Boulan from Bank of America. And the question is, can you describe the allocation of annual pension funding to the free cash flow and P&L statements? And if a pension funding has any tax implications?
So I'm happy to take this one. I mean, as I said before, we had this 269 funding in 13, 250 the minimum as described, and 19 for 3 other countries. So it's investing cash flow. That means it's outside of the definition of free cash flow. First point, it's just cash, so we're not talking about P&L impacts and no tax impact. So it's very straightforward, I would say. Yeah, you have to consider it as an investing cash flow outside of FCF. That would be it.
Okay, thanks very much. The next question comes via the telephone, and that is Ulrich Rade from Jefferies. May we have your question, please?
Thanks. I actually have 5 questions, mostly just short clarification. Andreas, stop me if you don't want them all 5 in one row.
I will do so, Ulrich, certainly.
The first one is actually really from a strategy point of view. Why did you decide to actually fund these defined benefit obligations, and why did you set the 50% funding ratio? What was ultimately the reason? Because you might as well have just carried the provision on your balance sheet and happily pay out of operating cash flows the way you did before. I'm just wondering whether you could sort of explain that in a couple of sentences. The second question is, I understand there's no legal obligation to do anything if the asset return in this DBO asset sort of funding ratio, if the returns aren't sufficient to get to 50%. But in practice, of course, you have set yourself a target. Do you have an answer? What would happen if your returns fell short, and you would see that the funding that you're currently planning does not get you to 50%? Would you then increase the funding, or would you simply say, fine, and we can't get to 50% funding ratio by 2020, and that's that? The third question is, in the cash flow statement, when you show the cash outflows for payments to pensioners, you sort of throw together the payments from provisions and from assets. I was just wondering, is there sort of some rule of thumb of how the ratio between the two might change over time? And what I'm aiming for at particular here is obviously one goes through the free cash flow, as I understand, and the other one doesn't. So I was just wondering whether, how the two parts of payments to pensioners sort of develop over time towards 2020, say, and what ratio they would be. And the fourth question is on slide 18, when you actually show the cash outflows. My assumption is, just for clarification, that this actually excludes the funding payments, right? It excludes, for example, for 2013, the 250 million funding payments, as I understand it. And my last question is also just clarification. The civil servants payments, you said the cash payments are equal to the P&L statements. This is all in EBITDA, correct? This is no element of interest cost in the P&L. Thank you.
Okay, yeah, thank you. Good question. So, I mean, obviously, I just wanted to take the third one, but I take all the other ones. So, funding, why? It was not so straightforward. I mean, to be very frank, it was quite a controversial discussion. I mean, one of the logics behind that is, as a matter of fact, year by year, we're paying less for civil servants. So we have some kind of a cushion there, and we said we could utilize it. The other thing is related to the reduction of interest rates. We have an impact on the DBO, as a matter of fact, and we have this average, DAX and groups with which we compare ourselves that have quite a funding ratio. Even if there are legal constraints related to that, but still. And so what we thought of is, it's not about having something short-term, but mid-long-term is having really here the flexibility to be able in future to pay directly out of the cash flow or to utilize the CTA. So it's really, we are in a position now where we can afford to do it. We really have, enough cushions to do so. So we say, okay, let's utilize these years to make the real thing for the mid-long term. So to say, for the next generation, and go for funding. You could ask, when you ask why 50%, it's because we believe that half of it being funded makes sense, but we don't want to fund everything, or we don't know why we should fund more. So half of it was rule of thumb saying that would be okay. Now, if the returns fall short, as I said, we have two options. As a matter of fact, the returns, or we fund more. And now the goal is really to fund by 50% 2020. So it's not to say, okay, we have less returns, so we won't reach the goal. We have always the possibility to fund more. 2 years ago, we made 750. So $500 million more. We have the flexibility in future also to adjust the funding to make sure that we reach the goal. Don't forget, at the point being, we have, I would believe, a number for the DBOs that is historically high because of their very low pension interest rates. The day we have a higher interest rate, and this day could come in the next 6 years, this would have a very strong impact, as you saw, with the sensitivities on the DBO. And this would automatically, as a matter of fact, improve the ratio also. This has quite an impact on the funding ratio, as a matter of fact, if the DBO goes down. Now, talking about, the rule of thumb, I would leave over to Andreas, who wanted to make
Ulrich,
a point here.
You asked for the expected cash payments in the future years, which are then being done through plan assets. We don't have any precise forecasts here to share with you. However, our general philosophy is to increase the funding of the plan assets. For us to pay out high amounts from the plan assets would be contradicting to that. So if you look at what has happened in 2013, so this approximately 40 million which were being paid out, that is, let's say that's the upper end of a level we would expect for the future years to be paid out through the plan assets.
Thank you, Andreas. And so now taking the two last questions, slide 18. As a matter of fact, here we don't have the funding payments. Why? Because we're only talking about the cash outflow, and once again to the civil servants and so on, to the beneficiaries. Let's put it like this. And when we fund towards the CTA, it remains in our firepower for being later on distributed to the end beneficiaries. So here we're talking about real external cash outflows out to the beneficiaries, first point. And then civil servants, these payments, we're talking about pure personal costs, so that these are operational, so these are in the EBITDA figure.
That's extremely clear. Thank you for bearing with me. Thank you for all five.
Thank you, Ulrich. The next question comes from Ottavio Adorisio from Societe Generale. May we have your question, please?
Hi, good afternoon, gentlemen. And I also apologize. I have probably more than a couple of questions. And it's a bit of detail. So let me just go. The very first one, a very simple one. You spelled out the assumptions you used for calculating your defined benefit liability. But I couldn't find the life expectancy. Could you just say what the life expectancy assumptions you have? The second, the assumptions. Who decides about these assumptions? It's basically the common assumption for all German corporates, or you have different assumptions from the one, for instance, used by Siemens. The third is about the pension asset. It's possible to tell us what the legal status, because being not compulsory for you to fund this pension liability, it looks to me that you put money in an escrow account. Could you draw back money from this particular account, or it basically is now ring-fenced and this money is basically left the balance sheet? The last one is basically is follow-up from the one asked by Frederick, really at the very first one. It's about the tax status about these pension liabilities. So anytime you contribute, assume that this basically lower your tax liability. So the 7 billion net pension liability you reported in the account, it's basically, I assume, gross of tax rather than net of tax. So it has basically, there is a tax shield as you contribute in future years. That's it.
Thank you very much for your questions. So I would start here with the assumptions first. I mean, colleague from HR will come with some more details, but as a matter of fact, and you see it in the annual report also, yeah, we have, let's say, a set of data for the calculations used by actuaries. So it's not done by ourselves. I mean, of course, here we have Thomas Watson doing the job. So, this is really their job, their expertise. So they're using data that is also being utilized, of course, by others. For instance, you have this Heubeck, this is kind of the data you would utilize on the market. But of course, I mean, even if the methodology of the actuarial companies is very much comparable among them, of course, the assumptions are very much related to each and every company. And there, I think the colleagues will be happy to give you a little bit more details on this one. But once again, the methodology, and this is done once again by external actuaries, of course, is very much the same from one group to the other. Now, talking about the legal status of pension assets, I think this is a very important one. As a matter of fact, and this is also part of definition of plan assets and very much related to our IFRS standards and rules. If we could directly at any time take money out of the fund of the CTA, that wouldn't have the status of plan assets. Yeah. So as a matter of fact, there are very restrictive rules to take it. It has to be utilized, of course, for the beneficiaries, as we said before. I mean, this is the main rule. The money is there for them. It's ring-fenced. It's going to be utilized for them. If we want to take this money to utilize it for anything else, then we would just, kill the whole construct we have here, and we wouldn't have the status of plan assets anymore. Yeah. So this is about drawing back some money here. And tax status of the liabilities, I mean, as you said it, yeah, you're right. We utilize our tax shield here as a matter of fact, and we have some tax deductibility. So you were very much right on the tax treatment. Yeah, so now I'll pass over to Carsten to give you some more hints and details on the assumption as such.
Okay, thanks, Guillaume. I try to add that. Regarding especially the life expectancy, we have, and Guillaume said that already, we use the so-called Heubeck life tables, which are very famous in Germany, and as far as I know, are used by almost every big company in Germany. Of course, there are other assumptions like life expectancy or salary increases, and they always have to fit somehow to the company. And I assume that, coming from your example, that we have some different assumptions here than Siemens does, and we always have to find some reasonable assumptions. So we always have to speak about these assumptions and with our auditors. Yeah, who decides on this assumption? It's us with the agreement of the auditors. And I think it's something open. No, I think that's it. So.
Okay, thanks very much. The next question comes in via email from Simon Whedon from Citigroup. And Simon, your question was, what is the tax benefit from pension payments in Germany? Is the tax offset taken when the provision is charged to the income statement or when the payment is made to the pensioner, or a bit of both?
I take that. Coming from the company's perspective, the tax benefit is directly taken when the provision is charged. Coming from the employee's perspective, it's deferred taxes.
Okay, the next question comes again from the internet by Jonathan Dan from RBC. In the circumstance of a large windfall, selling TMUS, would it make sense to accelerate meeting the 50% funding ratio?
I don't want to speculate here, but as a matter of fact, as I said, 2 years ago, we had a good possibility to make more, and we thought it would make sense, so we funded 500 million more and made a 750 out of it. I mean, at a certain point of time, for whatsoever reason, we have some more liquidities, or why not making more out of it? But what I would like here to say is, we have a plan till 2020, and there is no reason, for making just a huge funding and being there immediately. I mean, there is no hurry. So the goal is being there with 50% 2020. Once again, if in between there is some room to maneuver and we believe it makes sense to go for 1 billion, for instance, why not? But I don't want to speculate here.
Okay, thanks very much. Then we have again Ulrich Rate in the line with another question. Ulrich?
Yeah, thanks. I was just looping in to make sure all the other questions go through. But 2 questions. One is on slide 6, the civil servant payments. Could you give us indication when this number would start to significantly fall? So some point in time, maybe when it's half that 400 million that's it's still in there in the last year. And the second question is a follow-up to Ottavio's. I understand from your answer that it is ring-fenced, but also a previous answer, I think, suggests that it is ultimately a bit of a piggy bank, because you can at any point decide to pay the beneficiaries out of the assets, which wouldn't then help you with the payments from provisions, which ultimately then helps your free cash flow. So there is a degree to which you can indirectly draw upon this that gives you flexibility in your cash flow management. Isn't that correct? Thank you.
I would start with the second part. You're absolutely right. I mean, it's one of the reasons we make it. It's to have flexibility in the cash flow steering. But once again, it's very much related to pensions. I mean, we cannot utilize this money for anything else. So, yes, you're right. We can decide to have some payment out of the CTA. That's right. But only for pension beneficiaries, and that's the only thing that can be done here. But it allows us, once again, to have more flexibility, and this is one of the main reasons we're doing it. So on the civil servant payments, I believe Carsten is happy to give you some more details.
Okay, as you see on slide 6, there is quite a big decrease in the payments within the next years, which derives from some early retirement plans and programs. And then from 2016 to 2018, we have a slightly increase because of the early retirement programs which run out then. There are no longer older civil servants that will leave in these years, but we will shrink to about 100 million euros in the next 15 years.
Within 15 years from now?
From within 15 years from now, from 500 now to 100 in 15 years from now.
Fantastic. Thank you very much for both answers.
Okay, ladies and gentlemen, the webinar is about to end. Should you still have further questions, we kindly ask you to contact the Investor Relations Department.
We'd like to thank you for participating at this webinar. The recording of this webinar will be available for the next 7 days by dialing +49 1805 2043 089 via reference number 446826. We are looking forward to hear from you again. Goodbye.